There are fears of a bubble in bonds right now. There are guys who won't sort of sell this to their clients who want them. Explain what this is all about.
Well, we've seen now 3 bubbles here. We started with tech stocks in the 90s. We had real estate here in the 2000s. And now people are worried that we're going to have a bubble in bonds, particularly with individual investors.
Even though that conversation took place 7 years ago, believe it or not, analysts are still talking about it. But why? If the bond bubble hasn't burst by now, the question becomes, was there really ever a bond bubble to begin with? Should you be worried if you have retirement money in bonds or bond funds? Is this great bursting of the bond bubble still inevitable? Those are some important questions for any investor near retirement who has shifted their priorities to investing for income. Let's face it, bonds are income-generating investments and can be important tools for an income-based portfolio. But will that change if the so-called bubble bursts? It's time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. Hi everyone, and welcome to the Income Generation. I'm David Scranton, your host. When the stock market started soaring in November, right after the presidential election, the 10-year Treasury rate also spiked in the face of a bond sell-off, jumping from 1.8% a day before the election to 2.6% by the middle of December. The 10-year Treasury is considered to be the most liquid and widely traded bond in the world. And as it goes, so goes the bond market. Right after the election, we saw an old-fashioned flight from quality, with money coming out of government bonds and going into the stock market, causing the stock market to soar as bond prices dropped and bond yields went up. And that's fairly typical. But what happened after was anything but typical. As the stock market continued climbing all the way through March, the bond market stabilized. But each time it's gotten close to or just above 2.5%, it's dropped back again fairly quickly. Now, that's unusual, because the bond and equity markets tend to move in almost opposite directions. A flight from quality in bonds normally continues in conjunction with the stock market rally, driving up long-term interest rates and driving bond values down. That's how a so-called bond bubble might burst, for example. But that's not what we've seen. And to me, the reason is obvious. It's because we've never been in a bond bubble in the first place. Instead, what we're seeing is a bond market adapting to unprecedented new realities in the global economy. It's adjusting to a new normal that includes perpetually low interest rates and investors who are more influenced by artificial influences like quantitative easing rather than by economic realities. But just as importantly, we're seeing interest rates and thus the bond market influenced by an enormous demographic shift. Baby boomers. Baby boomers who are focused on investing for income. What does it all mean for you if you're part of this huge demographic, aka a member of the income generation? Today, I'll talk to Joseph Hogue, the author of Step-by-Step Bond Investing, a beginner's guide to the best investments and safety in the bond market. Later in the show, I'll be joined by some fellow thought leaders among financial advisors for another edition of my Financial Advisors Roundtable. But first, let's talk more about this so-called bond bubble. The idea behind the bond bubble is pretty simple. You see, when Treasury yields and interest rates dropped after the financial crisis, many analysts predicted that the market would have to move in the opposite direction. They've looked at the situation with interest rates the same way. When the Fed lowered short-term interest rates to near zero following the financial crisis, the most popular wisdom was, hey, since they can't get any lower, they eventually have to get higher. But here we are now, 8 years later, and short-term rates are still less than 1%. Economic conditions have not improved enough to give the Federal Reserve the confidence to hike them any higher. And as we discussed on a recent show, with long-term interest rates remaining low, raising short-term rates could flatten out the yield curve, which is detrimental for the economy. Japan is a great example of this, and a counterpoint to the idea that low interest rates must eventually climb. Their story is very similar to ours. You see, Japan had a financial crisis brought on by a collapse in the real estate market. That was then followed by a period of slow growth and also a period of central bank policy of near zero interest rates and quantitative easing. Subsequently, their 10-year government bond yield dropped below 2% back in 1997 and hasn't surpassed that mark over the last 20 years, not once. On top of that, the huge demographic shift we're experiencing right now in the United States started in Japan 20 years ago. That's when their baby boom generation started nearing retirement, started spending less, therefore generating less economic growth, and also in their personal investments focusing more on investing for income-generating investments, options like bonds. The point is that simple concepts like the one behind this idea of a bond bubble are rarely sufficient in today's financial world and are oftentimes an extreme oversimplification. So here's another simple but misleading concept about bonds. When interest rates go up, bond values go down and vice versa. Now, based upon that idea, some might try to argue that right now is a terrible time to buy bonds. Again, why? Because interest rates are so low that, hey, after all, they must go back up again. But we've already debunked that myth. But even if it were true, let's just say for a moment that it is true, there are other factors to consider, factors that many analysts, advisors, and unfortunately investors forget or ignore. For example, this thing called the risk premium. This concept is defined as the amount of additional interest that any rational investor would require to move from a theoretically default-free U.S. government bond to a corporate bond or a preferred. So why is it such an important concept to understand? Stick around and find out. But right now, it's time to get some insights on this topic from a very knowledgeable source. My guest today, Joseph Hogue, is a chartered financial analyst who has worked as an economist since 2008. He provides research and analysis for small and mid-sized firms in the investment management industry and also manages a consulting firm focusing on emerging and frontier markets. He is also a guest panelist for Bloomberg and an author whose latest book is called Step-by-Step Bond Investing, a beginner's guide to the best investments and safety in the bond market. So Joe, tell us why you wrote your book, The Step-by-Step Guide to Bond Investing. What motivated you to do so?
Well, mainly by just the fact that the average investor is very underinvested in bonds. All you hear about on TV, on the internet, is stock investing, and that obviously we've seen over the last 2 decades leaves investors at risk, leaves their portfolios at risk, and leaves their retirement at risk to a 50% sell-off. So investors need to know what kind of exposure they need to bonds and how to invest in bonds.
So Joe, why do you think that is? Why do you think that, the media doesn't talk about bonds that much, advisors don't talk about bonds, Wall Street doesn't talk about bonds? Why do you personally believe that is?
Well, bonds aren't sexy. They are the safety investment. Okay. They're the income investment, and they don't draw viewers. They don't draw a lot of page views for the web, and those page views end up being advertising income. So most analysts, most programs focus on what draws the most viewers, and that just happens to be stocks.
Yeah, no, you're so funny. You're preaching to the choir. I believe the same, 110%. And I know you mentioned bonds. I know from your book that you're really a fan of individual bonds. But it's so funny because it seems like most advisors today, when they put somebody in bonds, they do it almost as an afterthought, and they use bond funds. And yes, bond funds have a niche, although you and I are both bigger fans in most cases of individual bonds. So when do you think bond funds make more sense versus when do you think individual bonds make more sense for a particular investor?
Well, there's a reason why most shows and most media pushes bond funds. It's because, again, that's where the eyeballs are. The vast majority of Main Street retail investors are going to be investing in bond funds just because of the fees involved. Now, I will say that I prefer direct investment in bonds, but it may not be appropriate for people with less than around $150,000 to put 2 bonds. And that's just because of the transaction costs involved in buying individual bonds. Bond funds can be bought just like stocks. Yeah. for a $10 commission, but they don't give you that customization that you get from buying directly in bonds. They don't give you that income, that laddering approach that you can use with direct investment in bonds. So there's a lot to be said for direct investment if you have those means.
Yeah, and it's I believe part of the reason also is that a lot of advisors today really don't understand bonds. I think they should, frankly, read your book. It's kind of like today, if you're out on the water, we get so used to having GPS technology and everything else that nobody knows celestial navigation anymore. In some ways, financial advisors think of bond analysis as celestial navigation, and it's kind of sad, isn't it?
Sure. Well, it is, and it's because I think investing has become more about entertainment than about good analysis and good advice. It's selling
hey,
that.
don't go knocking financial television shows now when you say it's become entertainment. Okay, just be careful there. I'm just teasing. Joe, what do you think are the most common?
I'm sorry. It's more about the easy route rather than what people really need to do, the detail and the work that's involved in investing.
What do you think are the most common misconceptions that investors and advisors alike have about bonds?
Well, right now there's a huge misconception about rates and about the outlook for bonds. We've had a 30+ year bond bull market where rates have come down from double digits in the 80s to 2.5% on the 10-year U.S. Treasury. And people are looking out into the future and predicting that rates have to go back up to those points, which of course would be bad for bonds. And it's just not the case. There are several factors pointing to a flat or very slowly rising yield curve for rates, and bonds should be a very good investment over the next 10 and 20 years.
Yeah, it's interesting to hear you say that, because what our viewers need to realize first and foremost is that we've gotten you in here via Skype technology, and you really haven't seen the rest of the show, and we've actually talked about just that. So, my friend, you are like, as they say, a brother from another mother, I swear. But stay with us if you can. We need to take a commercial break, but I'd like to have you back for one more segment. We have many more important things to talk about bonds that you, our income generation members, must know. So stay with us. We'll be right back. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Welcome back to The Income Generation. Now let's bring back our guest, Joseph Hogue, chartered financial analyst who wrote the book called The Step-by-Step Bond Investing, a beginner's guide to the best investments and safety in the bond market. Thanks for sticking around, Joe.
My pleasure.
What do you think about what's happening right now with interest rates in the markets and so on? The 10-year Treasury rate went up a lot right after the election, but yet it seems like a lot of other interest rates on a lot of other investment grade or mid-grade bonds haven't really increased, and the bond markets haven't really taken a hit. In your own words, why is that?
3 things really that investors need to remember about the rate outlook for interest rates, both on the U.S. Treasury, on the government bonds, as well as on corporate bonds, because they are, over the longer run, they are going to move more in tandem. global demographics, the aging population, not just in the United States, but across the world, and productivity is going to be a natural limiter on inflation and rates. The oil boom in the United States that's given us that oil independence is keeping a lid on oil prices. And then the possibility that Washington wants to see a more dovish or a lower rate Federal Reserve. We've got quite a few Federal Reserve members that, including Fed Chair Janet Yellen, that are coming up for re-election or changing. And the pro-business government in Washington might just want to see lower rates for longer. So there's a good chance they're going to.
So Joe, that brings the question then. That begs the question, what do you think is the new norm for interest rates over the next 5 or 10 years or so?
The new norm is clearly lower. The U.S. 10-year is 2.5 now. I'd say 3.5, maybe 4 at the most over the next 10 years. You've got several changes in the business cycle over that period that are going to require the Fed to lower interest rates. And then you just have those natural limitations on inflation and on economic growth that are going to act to hold inflation or interest rates down. So
now, are you one of these people? Are you one of these people that think that by the end of this year we could actually have a 10-year Treasury under 2%, or do you think this year it's going to stay in the 2 to 3 range?
I'd say it will probably stay within the 2 to 3 range. There's still a lot of pro-growth business policies that we're waiting on out of Washington that are, even if we don't see them enacted this year or even early next, they'll act to increase business confidence and investor confidence, which will help push the economy. So that's gonna act to keep interest rates bound between 2 and 3%. I would say over the next few years, there is the chance that the business cycle will turn and we will see lower economic growth, which may push rate down further. But there are a lot of factors pushing and pulling the rate outlook.
So 4% in 10 years, but they can go lower before they go higher. So where are you telling people now the best opportunities are in the bond market?
Well, right now, investing has always been a much more personal idea than most people realize. It has to start from your own return needs and your tolerance for risk. That said, there are opportunities in callable bonds, bonds with call options. So if interest rates go down, companies can buy the bonds back and reissue bonds at lower rates. Well, the odds of interest rates going down are much lower. So those callable bonds, which you get a little bit higher premium, most likely aren't going to be called. So there are opportunities in bonds that have those call options on them. For investors in the higher tax brackets, 25, 28% or higher, there's also opportunities in those municipal bonds. Those are federal income tax free and local and state tax free as well if you live within those jurisdictions. And of course, as always, you want to hold those municipal bonds, those tax-exempt bonds within your taxable accounts, and your taxable bonds, like corporate bonds and other bonds, in retirement accounts to get the best of both tax advantages.
So in the 30 seconds or so we have remaining, what do you tell younger folks that aren't members of the income generation, that are under the age of 50, that say, oh, bonds are for babies, those are for older people, I don't need bonds? What do you tell them, about balancing out their portfolio?
Sure. Well, you always need bonds. If anybody that's been investing over the last 2 decades can tell you that bonds offer an excellent opportunity, considering the wild ride stocks have had. Bonds have returned just over 5% annually over the last 20 years, stocks 8%, but bonds did it with about a fifth the volatility as stocks. So when you look at that risk-adjusted return, bonds are actually a very good bet. And they provide the kind of safety that investors need for when stocks don't play nice.
Of course. Best advice I give to our income generation viewers is, if they're interested in bonds at all, and hopefully if you watch your show as a regular viewer you are, go out and buy Joe's book, Step by Step Bond Investing. It's a great user's guide. So Joe, Thank you so much for being here on the show today, and I hope you'll come back.
Thank you, David. My pleasure.
Now let's talk more about bonds and this bond bubble, so to speak, and the bond market overall. One of the most important factors when looking at investing in the bond market is this concept of risk premium. I mentioned this earlier, but risk premium is, again, defined as the amount of additional interest that a rational investor would require to move from a theoretically default-free U.S. government bond to, let's say, a corporate bond or a preferred stock. Here is why risk premium matters to you. You see, before the entire financial industry began collapsing about 10 years ago, the 10-year Treasury rate was about 4.76%. A BBB rated preferred, though, for example, was yielding about 6.5%. That means that the risk premium for preferreds was less than an additional 1.75%, meaning that a rational investor would have been willing to risk moving from a government bond to a preferred for a gain that small. Now, that may seem outrageous based upon today's standards, but there's a simple explanation for that. If you remember, people at that time, back toward 2007, were overly confident about the economy. They were convinced that we'd recovered permanently from the dot-com crash and that the worst days were over. That misguided optimism led them to require such a low additional risk premium for going from government bonds to preferreds. Today, of course, the 10-year Treasury rate has dropped from 4.76% to below 2.5%. Yet the dividend yield on a preferred, let's say, is now about 5.75%. That means the risk premium has now almost doubled to 3.5%. But at the end of the day, the interest rate on the preferred dropped only 0.75% over that 10-year period, compared to nearly a 2.5% drop in the Treasury yield. So what does that mean? It means that when interest rates dropped, the price on the government bond went up a lot more than the price on preferreds. Why? Because the growing risk premium absorbed a lot of that change. So the question becomes, why has the risk premium nearly doubled over the last 10 years? Because that misguided optimism is now gone. The crash of 2007 to 2009 was a wake-up call that the worst days weren't really over. That pessimistic feeling resonates among investors still to this day, despite what the record-breaking Trump rally might suggest in the financial market. Here's the most important thing to keep in mind. This same phenomenon could actually play out in reverse, in the opposite direction. If the Fed does raise short-term interest rates and the rate on the 10-year Treasury increases, it will likely be because our economic confidence has finally returned. And with that, the risk premium should shrink again, which would mean that the interest rates on government bonds could very well increase more than those on preferreds. And therefore, the price of Treasury bonds this time could drop a lot more than the price on preferreds, the opposite of what we saw between 2007 and now. Now, is there a guarantee that the risk premium factor will always offset the changes in the value of corporate bonds or preferreds due to changes in interest rates? Of course not. But it's important to understand that it's typically a mitigating factor. Here's the bottom line. Cause and effect concepts may be easy to grasp and might be simple, but when it comes to the market, things are rarely that simple. When it comes to bonds and bond-like instruments, remember, the effect of interest rates is really only just part of the big picture. Coming up in just a bit, I'm going to talk more about bonds in today's markets with fellow advisors at my Financial Advisors Roundtable. But before that, Miranda is going to break down some of today's most important financial headlines. So stay tuned. You're watching The Income Generation.
And welcome back to The Income Generation. I'm Miranda Kahn, and here is your Newsmax Finance Update, a quick recap of the stories that moved the markets this week. President Trump tells the Wall Street Journal that he won't brand China as a currency manipulator. The president also argued that the dollar is getting so strong that it's actually harmful to the U.S. economy. U.S. 10-year bonds slumped and the dollar fell following the president's comments. His blunt remarks signal a departure from most presidents who usually steer clear of commenting on the value of currency and in order to avoid jolting financial markets. The calm in the stock markets may be over as American and European investors rush to hedge against declines. This comes after the Credit Suisse Fear Barometer neared an all-time high this week. That barometer measures the cost of buying protection against declines in the S&P 500. And Amazon CEO says artificial intelligence will fuel his company's future success. According to the company's shareholder letter, Amazon also plans to enhance its voice-activated Alexa assistant and create new tools to sell through its cloud computing division. For more on these stories, please visit newsmax.com/finance. I'm Miranda Kahn. Now back to David Scranton and the Income Generation.
Now that you're all up to date, let's hear from some financial advisors in the field other than myself and get their thoughts and insights on bonds and bond bubbles. It's now time for another Financial Advisors Roundtable. Joining me today are Mark Falter, Jim Lineweaver, and Jay Carrier. Please welcome back Mark Falter of Mid-American Tax Advisory Group in Kansas City, Missouri. In addition to working with clients, Mark shares his expertise on his own weekly radio show and as a frequent guest on financial news outlets like Fox Business News. Good to have you, Mark.
Thanks for having me, Dave.
We're also happy to, you're very welcome. We're also happy to have a very close friend of mine here, Jay Carrier of Scranton Financial Group in Westbrook, Connecticut. And if the name sounds familiar, Scranton Financial Group, it's for a very good reason. It's because Jay is my partner at Scranton Financial Group. And Jay's been in the business now for over 15 years, specializing in personalized retirement planning and comprehensive portfolio management. Welcome, Jay.
Thanks, Dave. Welcome.
Right. And also joining us is Jim Lineweaver, founder and CEO of Lineweaver Financial Group in Cleveland, Ohio. Jim and his team have been providing sound retirement strategies and financial solutions since 1993. Jim, welcome to you also.
Hi, guys. How you doing?
We're doing great. Now, listen, Jim, can you guess, beside your wealth of knowledge and your nearly 25 years of experience, can you guess what other reasons we invited you on the show today by any chance?
It could be, let's see, the Cleveland Cavaliers. It could be the Cleveland Indians who won their home opener. There's a lot of reasons to get me on the show today.
It's none of the above, and you wouldn't be able to answer the question. It's kind of unfair because you can't see your other guests. But of all of our guests today, let's just say you're the only one that has hair. Okay. So that's the other reason I wanted to put you on the show to break up the bald is beautiful theme a little bit. So with that in mind, let's talk about the stock market for a minute. This show's about bonds and interest rates and all that, but I'd like to get your feedback for where the stock market is now. Is it high? Is it due for a crash? Do you think there's more upside in the market? Do you think the Trump rally can continue? What are you telling your clients when that question is posed to you?
Well, I think we've had a decent run here, and we've had a little bit of a pullback, but I think we're going to have more volatility going into the summer. I don't think the market thought it would be so easy, they thought it would be so turbulent to get these things passed. And because they're getting hit with some headwind, I think that's causing some investors to pause, pull back, rethink. And I think that's going to lead to some volatility until something concrete can get passed.
And that's the toughest thing when it comes to handicapping. It's easier to handicap the success of the Cavaliers or the success of the Indians than it is the markets because of that uncertainty. But if I put your feet to the fire, if I said, okay, is the market going to end higher or lower on December 31st of this year relative to today, what would you tell me?
Well, I'd have a clause in there that says if he can get at least one thing passed, lower taxes, deregulation, something, I would say we're going to be higher than we are today. However, the other half of the gains in the market are really on speculation that some of these things are going to come to fruition in the next few years. And I think that's the risk that we might give up if something isn't concretely done and passed by the end of the year.
Okay. All right. Fair enough. Well, it's, I have to tell you, Jim, I think you missed your calling as a lawyer because you put that clause on the bottom of it. So maybe in another life you can come back as an attorney. I'm not so sure. Mark, talk to me about the markets. What do you think? What do you think about the stock market? Do you think it's super high right now? Do you think it has more legs? We all know it's kind of close to a record high. The pullback hasn't been that big, but how do you answer that question when clients pose it to you?
Tell you what, I think it obviously is at an all-time high, but I actually think it's got some ability to go a little further. I think, not for the record here, but I think there's a good possibility we could be looking at a little bit higher market at the end of this year than now, mainly because of optimism. A lot of optimism out there. Not to say that it's not. And you live in a pretty conservative
part of the.
Go ahead. I'm sorry.
I was saying you live in a pretty conservative part of the country, Mark, too. So my assumption is, are most of the people that you talk with on a regular basis, pretty optimistic because of the new president? Is that what you're hearing also from them?
people are optimistic on what Trump is going to do. It's kind of a new era that we're in. We don't have a politician in office anymore. I think there's a lot of optimism in there. I think we're going to have a correction. I really do. But I think that the rest of this year, it's a very strong possibility we could be looking at a little bit more trending up.
Okay, that's great. Now, Jay, we share research all the time, so we tend to think a lot alike because of that. And we have to, because our personal clients want to make sure that we're on the same page. But sometimes we differ a little bit. We don't always totally agree. So again, what are your thoughts about the market? You're talking to Mark, who comes from a very politically conservative area in Connecticut, right? We're not so much from a politically conservative area. So when you meet with your clients one-on-one, what are they telling you? Are they optimistic? Are they pessimistic? And what do you think?
Well, first off, it's tough to follow Jim because I'm going to kind of piggyback of a few things that he said. But we see a little more pessimism right now than optimism. And I would kind of agree with what Jim had said that, the Trump rally was really based on perception at this point. And he hasn't passed anything yet. And he's, whether you want to use the word flip-flop, and I'll use a recent example of him coming out and saying China is not manipulating interest rates or their currency. Well, that was a flip-flop from his rhetoric that was going on during the election.
And that gets people questioning things and feeling perhaps a little bit less confident.
Right, so here he is, providing all of this optimism. Going forward, he's going to pass tax reform, he's going to have deregulate, he's going to put together a $1 trillion infrastructure plan. But the reality is that none of those things have happened yet. And every time he I don't want to use the word flip-flop, but every time he does make a statement that contradicts his previous one, we see the market pull back.
So in the 30 seconds we have left in the segment, tell me, best guess, December 31st, the market be higher or lower than it is right now? Jay?
Fortunately, I think the political system is still too polarized. I think it's going to be lower.
Now, wait a minute. Jay, how many times have I told you we're not supposed to be making market predictions to our clients? I'm just kidding. Stay with us. We have a lot more to cover with our Financial Advisor Roundtable, so stay tuned. We'll be right back. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. Let's jump right back into it. Today we have Mark Falter, Jim Lineweaver, and of course my business partner in Westbrook, Connecticut, Jay Carrier. Jay, I had to cut you a little bit short there for a minute, and I apologize for that. But I only apologize because he's a lot bigger than me. That's why I apologize to him for cutting him off. So, but here's a good question. Bonds, bond market, the whole purpose of our show today. At the end of this year, do you think bond yields are going to be higher? Do you think bond yields are going to be lower? What's your best guess to tell our income generation members over the next few months?
Best guess is stagnant bonds or lower, and simply because now you've talked about the
lower bond prices or lower bond yields?
Yields.
Lower bond yields.
Yes.
Okay. So higher prices.
Correct.
Okay.
And you've talked a little bit about the risk premium between corporate government bonds and preferreds.
Yes.
Well, let's talk a minute about the risk premium between U.S. government bonds and other countries' government bonds.
Yeah, we haven't talked about that in the show yet, so that's a Go right ahead.
So here we are, the United States, still the safest government or safest currency and bonds in the world.
At least in theory, right?
Yes. And our yields are still paying higher than everybody else. So you have Spain, Italy, Portugal, Germany, Japan. Really the only countries that have yields higher than us are India, Brazil, and Russia. So we have countries all over the globe with less bond yield than our 10-year government treasury.
So theoretically higher risk of default, but yet they're paying less interest. So something doesn't make sense. You're kind of saying that that's going to act as a governor to keep our interest rates from going up too much, if I understand you correctly.
Correct.
Okay. Smart answer. Actually, I'm the smart one because I'm the one who made him partner of Scranton Financial Group. Jim, talk to us about your thoughts on interest rates and bonds over the rest of the year.
Yeah, we think we'll get about maybe 2 more upticks in interest rates. I think with what Yellen came out with last week and just said it's going to be slow, moderate, really get a gauge of what our economy is doing so that she doesn't, put the brakes on too fast. And I think that would be pretty well received by the overall market.
Okay, great. Okay, Mark, your thoughts on the bond market throughout the rest of the year and interest rates. What do you see?
I think interest rates very readily could drop a little bit, but something we've been implementing a lot in our portfolios are preferred stocks, and the higher dividends.
Now, of course, Mark, you're talking about long-term rates dropping. You're not talking about Janet Yellen reducing short-term rates. You're just talking about long-term, correct?
Correct. Yeah, and I think she's probably going to raise rates a little bit this year. Yeah, but I still think, like I said, I still think we got some legs in this market for the remainder of this year.
Okay. So you think legs in the stock market, but Mark, do you think the legs in the stock market are going to come from a flight from quality, so that government bond prices drop and government bond yields go up as money flows into stocks, or
Correct.
do you think that there's enough money sitting on the sidelines after 2009 that bond prices could go up and stock prices could go up at the same time?
That's exactly what I think. I think there's been a lot of money sitting on the sidelines that's ready to go in and is going in. People want to make some money.
Yeah. And Jay, same thing here. You see that too. I know we see it in Connecticut a lot. A lot of people just sitting there waiting. Even some people who were vehemently opposed to President Trump are still getting to the point where they're just saying, "Hey, let's just get in. We can't afford to make zero in a money market for any longer." So in the last 30 seconds or so we have, tell me what are you hearing from people, in a place like Connecticut, a slightly more liberal state, and what are you telling them?
Still hearing that pessimism, and they may have jumped in. They just, as you would say, capitulated and finally gave in and jumped in somewhere. Their finger is over the button.
So you're thinking that because of that, if anything, we could see even lower interest rates toward the end of the year on the long-term side due to a flight to quality, in essence.
Agree, correct.
So, and income generation members, that's what makes this so incredibly challenging, is all kinds of different opinions from a bunch of people that are equally as intelligent. So we're going to take a break, we're going to come back, and when we come back, we're going to talk a little bit more about bonds and interest rates and what you need to know as an investor. Stay with us, we'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Welcome back to the Income Generation. I'm David Scranton, and we have with us Mark Falter, Jim Lineweaver, and of course, Jay Carrier. Now, Jim, you said that some of the sovereign debt from other parts of the world has worked well so far. Give us the Cliff Notes version of whether or not you're still recommending that today, or do you think that's already run its course?
I think it still has some more opportunities. I think if you really look over the last couple of years, they were, sometimes beat up tremendously, just like the emerging market equities were as well. So it's something you have to monitor. It's not a big piece of our portfolios, but it rounds it out nicely. And it's providing us with some additional yields and additional returns that I think at this point in time in a rising interest rate environment in the United States can really help the portfolio.
So it's still good, still opportune. Mark, what are you telling your clients who want income?
Well, honestly, we're looking at common stocks that actually pay dividends. Also, of course, like I mentioned earlier.
What kind of dividend yields are you able to get with that strategy?
Typically in the 3 to 5% range. And biggest thing is a lot of these clients we're talking to still think, they want some growth. We don't want to do that with the entire portfolio, but they want, and that you still get that steady income.
So, and that's a great strategy. If people think there's more upside in the market, why not? Now, if you're in a more liberal state like the state of Connecticut and people don't think there's a lot of upside in the market, now what are you telling your clients, our clients?
Right.
Now, I should know this before Jay comes on the show, just in case you're wondering. What are you telling our clients about what to invest when they want income?
Well, our strategy now for the last 20 plus years is, we're heavily into preferreds. We're heavily into individual bonds.
Okay. So all the traditional stuff.
Yep.
Yeah. And I know we talk all the time about the fallacy, like we talked about in the show about, interest rates going up and bonds going down. The reality of it is that this whole thing with this risk premium is a huge differentiating factor. And with the demographic trends that we're seeing, I agree. I don't see a major change anytime soon. Just a lot of money flooding in different places, and people are looking for income. That's why we call all y'all the income generation, because it's a natural tendency that when people near retirement, they realize that the future has become the present, and the reality is that it's no longer about growth and crossing your fingers and toes hoping to have more money in the future. It's really about, as our clients know, it's really about income today or in the short term. So stay with us. We'll be right back with one more segment with our Financial Advisors Roundtable, where we're going to do a little quiz. We're going to ask them a very difficult question. So you're going to want to make sure you stay with us. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm joined here today with Jay, Mark, and Jim. And thank you for coming back, gentlemen. As promised, I have a very difficult question to ask all y'all right now, and that is this. The 10-year Treasury rate went up from 1.6 to 2.4 right after the election, of course, about 5 weeks. It's a 50% increase. Bond prices dropped. I want to know what each of you told your clients on their bond portfolios. Mark?
Well, we prepped clients in advance for this and told them, and the biggest thing that we told them and reminded them, should I say, is the income stayed the same. And that's what they're really in this for, is the income.
So the price dropped, but if they're in it for income, it shouldn't matter that much. Great. Jim, what did you tell your clients?
Yeah, Dave, we actually, the way we structure our income portfolios with either individual laddered bonds or some of these other, international bond portfolios, emerging markets, or even some international funds, their income was great, worked out well. Didn't see much of an impact as a lot of other fixed income portfolios did. So it was really a non-issue for our clients.
That's the problem with you Clevelanders, just because you got the Indians and the Cavs, you think you're better than the rest of us. Jay, what did you tell our clients when that happened?
We didn't have to tell them much. Our portfolios on average lost only about 2 to 3% over that time period, and you know this, and we've since recovered that, and we're well back into the black.
We did that good of a job.
We did.
Wow, I didn't know that. That's great news. Anyway, gentlemen, thanks so much for staying with us. You've been great today. Thank you. Before we go, I'd like to thank all my guests, as well as you, our new and returning viewers. When it comes to financial planning in the financial markets, you hear a lot of different things from a lot of different sources. But it's always important to consider what your sources really are and to try to understand the perspective behind the information or opinions that you're hearing. That's certainly true anytime you hear an analyst or advisor talking about the bursting of the bond bubble or saying that bonds are always a bad investment when interest rates are low. As we've seen today, it's never that simple. In truth, there are many different factors to consider. There are emotional factors and the new realities of a global financial market that's unprecedented in so many ways. Any advisor or analyst who ignores those factors may have hidden reasons for doing so. It could be that bonds in general simply run counter to his or her stock-based philosophies and business model. Or maybe in the fixed income world and individual bonds in general, they just don't view them as being something that's important. But let's face it, bonds always have been and always will be an important and viable tool for reducing risk and investing for income. That hasn't changed in the course of 2 major stock market crashes since the year 2000, and I doubt that it will change after the next one. Thanks for watching.